Hello, this is Jessica Fox from Florida Virtual Bookkeeper, and today I want to talk about how to understand your financial reports. There are three key reports that every business owner should be looking at, that you will want to be paying attention to and understand so that you can be making informed and sound financial decisions for your business. Today, I'll be talking about the balance sheet. The balance sheet is a report that I notice is very often ignored by business owners. Many times I noticed, we want to look at the profit and loss or the income statement and we just go straight to the bottom line. We want to see our profit. But that's just a small component about the performance of your business and the health of your business. If you've ever tried to apply for a loan or have started investing, you will have noticed that those people will have asked you for a balance sheet and place quite a bit of importance on it. So you should as well. In this example, I will be showing QuickBooks Online. However, these principles apply regardless of what accounting software you use. The balance sheet is essentially the same. So in QuickBooks Online, I am in the reports page. I'm just going to go to the balance sheet. And this is Craig's Design Landscaping Services, a sample company. I want to see what the balance sheet was as of last year. So I am just going to refresh that right here. Now, what is a balance sheet? A balance sheet is like a report card. It's a snapshot of the financial state of your company as of the date that you run it. So in this particular case, the snapshot that I'm looking at is as of December 31st. Things may have been different December 1st. Things may be different now in January when I am recording this. So imagine it's like taking a picture and seeing what the financial situation of the company was at that time. Now, the balance sheet will tell you one of two things: either what the health of the company is or that the fact that the books are no good. It won't tell you both at the same time. So if you are doing your own books, the balance sheet is a pretty good indicator of how well you have been doing at keeping your own books. If you have a professional that's keeping your books, they should be reconciling all of the balance sheet, not just the bank accounts, to make sure that everything is accurate. So when I get a new client, the first thing that I do is I review the balance sheet, because that will tell me, is like, are the reports any good? You do not want to be wasting time looking at data that is flawed. So in this particular case, I haven't looked at it yet. We'll look at it together. But just so that you know why it's called a balance sheet, it means that assets equals liabilities plus equity, and both numbers should balance. So here we got the total assets, 24,336 and 29 cents, should be the same as the total liabilities and equity of 24,336.29. If you're doing your own books manually, the old-fashioned way, this is something that you want to make sure that it has to be in balance. If you're using software, it should automatically balance for you. There are some rogue cases where a balance sheet in QuickBooks will not balance, and that lets you know that there's something major going on with the book. So that's something that you will want to pay attention to. So that's the first thing that I look right off the bat before I look at anything else. I want to make sure that those two numbers are the same. They always should be. So in this particular case, Craig's assets includes his bank accounts, his savings accounts. These are the balances as of the books. They may not match the balances in the bank. So that's something that you want to pay attention to. If the amounts don't add up, if they're not the same, you need to know why. Were the books reconciled? Hopefully they were. That's a very important first step in having good books. If they are reconciled and the amounts are not the same, then it's usually easily explained by checks that you may have written that have not been cashed yet, or deposits that are still in transit that you may have deposited to the bank, but they did not credit until a different day. So always make sure that your bank balances look right. And if they don't, you can click on any of these amounts and see what transactions comprise those results. Thing to know about QuickBooks Online: if you are running the balance sheet for a period, like in this particular case, I selected the entire last year, Even though this number here is just the number as of December 31st, if you click on it, it will show the list of transactions for the entire year. So if you're looking at a balance sheet for a different period and you click on it and it only says opening balance, all you need to do is expand the date range, change it to all dates or a bigger range, and then you'll be able to see the rest of the data. So in this particular case, we've got accounts receivable. This means that these are invoices that we've sent that we haven't gotten paid for. That's something that you also want to keep an eye on. You want to know how much money you have floating out there that is owed to you. You do not want to let those invoices get too old because they become harder to collect. So by knowing this amount, you can take a look at your invoices and see, is this accurate? Sometimes it may look like you have a large amount in accounts receivable, but in reality, you did get paid, and that's an indication that something was not entered correctly and your income could be overstated. So you also want to make sure that you look at your open invoices and make sure that they're truly still open. If you have inventory, that will be shown in here. Undeposited funds is an account that tends to be QuickBooks specific. If you use different software, you may not see this. This just means payment that you collected that has not made it to the bank yet. Say you collect a check from a customer today and you're not going to the bank until tomorrow. When you receive the payment in QuickBooks, the default setting, unless you change it, is it'll go into undeposited funds. Then once you go to the bank, you will enter the deposit and take it out of undeposited funds into the bank account. So this is something that you also want to keep an eye on, because I see very often some business will have a huge amount on undeposited funds and they've deposited everything. So that means that there's something up with the books that you need to take a closer look and needs fixing before you can rely in this report. Then we got the fixed assets. This business owns a truck. Good for them. One of the things that you want to keep in mind is if you have fixed assets, that they are all reflected in the balance sheet, and that depreciation or amortization, depending on the type of asset, is reflected. Many times I'll see a business bought a truck 5 years ago and we still only see the original cost in the balance sheet, but you've been taking depreciation in the tax returns. That needs to be entered. That's not giving you a full and accurate financial picture. So if you've ever dealt with the bank or trying to get a loan, things like that, you notice that they'll nitpick little things like this. So information is power. Now you know what to look for before you present those numbers to somebody else. So now moving on to the liabilities and the equity section. This business has accounts payable of $1,602.67. These are bills that have been received that have not been paid. You always want to make sure that this amount is accurate. You do not want to be showing more liabilities than you really have. So take a look at your bills. Do you pay them all? Do you truly owe them? And then credit cards will also be included in this section. If there are bank fees connected for the credit cards in QuickBooks Online, this still only takes what's called the register balance. So you want to make sure that this matches what the actual balance is in the credit card for that day. And if the numbers don't match, that you know why. Could it be because you made a payment that hasn't posted yet, or you had some transactions that are still pending and haven't actually posted to the account? Any other liabilities that your business may have. In this particular case, it most commonly is things like sales tax, payroll liabilities. Then we go into long-term liabilities. These are things that you owe but are not going to be due in full for the period of the balance sheet, usually the fiscal year. So it's something that you owe and that's long-term. An example would be a mortgage. That would be a long-term liability. And then we go into the equity. Opening balance equity is an account that is created by QuickBooks by default for whenever you're setting up the books or you're creating a new account. That opening balance that is set up has to go somewhere. So QuickBooks posted an opening balance equity. This is a temporary placeholder account that shouldn't be there. So if you have a number in there, and that should have eventually been moved to retained earnings or owner's equity or something else. If you don't know what I'm talking about, don't do it yourself. Reach out to your accounting professional or financial advisor and they can assist you with that. Retained earnings are previous profits that were kept in the business. So in this particular case, it looks like Craig doesn't have any retained earnings, but he does have a net income of $1,777.81. This net income comes straight from the bottom line of the profit and loss, the report that most of us tend to look at before anything else. By next year, that net income amount will move to retained earnings. So that way you can have a clear distinction between what is the profit from this year and what is previous year profits that were reinvested in the business. So that is the balance sheet in a nutshell. Your balance sheet may have additional line items. For example, depending on the type of business entity that you have, you may have things like owner investment, owner's draws, shareholder distributions due to shareholders, stocks, etc. So this is just a brief overview so that you can have a better idea. Normally, when people are looking at the balance sheet, you want to have strong assets, you want to have as few liabilities as possible, and you want to have good equity. This is very important if you're looking for business valuation, you're looking to sell, or you're looking at investors. They want to see that the business has good equity, not just assets. So I hope that this is helpful. If you have any questions or concerns, I am only an email away, Jessica at floridavirtualbookkeeper.com. I hope you have a great day.